Welcome to EC4334 Financial Market Microstructure.
I'm Brian and I will be bringing you through this video. These are my group members Kim, Cheryl and Yongyang. Today, I will be sharing with you guys about a fascinating topic that is currently in the limelight. With coverage from major news networks CNBC, Bloomberg and the New York Times, the relationship between stocks and bonds is now the talk of the town. For the past 16 years, stock price and bond yield have moved in opposite directions. When a bond yield increases, the stock price decreases. However, in recent times, this trend has shown signs of reversal. Experts are currently locked in a heated debate as to whether bond yield and stock price will actually move in tandem. We are trying to explore the relationship between stock price and bond yield and whether this correlation is negative or positive. Let us first hear what the experts have to say about the current issue. John Norman, please.
Prices. We usually think of these two prices as moving inversely, and that means in balanced portfolios, if stocks are falling, then bond returns offset that. But what was interesting last week is the reversal of that correlation.
Thank you, Mr. Norman. So how will this reversal in the relationship between stock price and bond yield affect the decisions that investors have? If this trend continues, more investors would not choose to utilize bonds as a means to hedge against risk in times of poor stock performances. It is thus very important to understand the relationship between stock and bond movements in order to educate investors like you and me in making optimal investment decisions in their portfolios. Let us focus on two research papers regarding the relationship between stocks and bonds in the past 30 years.
Kim and In's paper looks into the relationship between changes in stock prices and long-term bond yields, both in the short run and long run in each of the G7 countries. They find that there is a negative relationship between changes in stock prices and changes in bond yields in most of these countries.
In Schiller and Beltratti's paper, while they agree that there could be a negative relationship between bonds and stocks using the present value models, they find that a positive relationship is also possible because movements in long-term interest rates may be related to information about the future dividend stream on stocks.
Their findings have also shown that the stock market overreacts to the bond market.
This means that there are conflicting views about the relationship between stocks and bonds. We seek to further develop previous research approaches to explore a more insightful perspective on this relationship. In Kim and In's paper, the authors focused on the relationship between the stock market index and bonds. However, we feel that solely focusing on a country's stock market index is too broad an approach, since it undermines the relative weights of the stocks that are included in the stock market index. So what will we be doing? By focusing on industry-specific stocks instead of the general stock market index, we will be able to gather more insights on the relationship between stocks and bonds. In particular, we will be looking at these industries: consumer discretionary, consumer staples, energy, financials, healthcare, industrials, information technology, materials, telecommunication services, and utilities. For bonds, we will be focusing on US Treasury bonds with yields to maturity of 7, 10, and 20 years. We'll be utilizing weekly data of US stocks and weekly data of bonds and its lags for the last 3 years from 1st March 2015 to 28th February 2018.
Our paper will focus mainly on utilizing an autoregressive distributed lag model to regress the change in stock prices for each industry on the change in bond yields and its lags. We will also control for inflation and GDP growth rate in our regression. However, since weekly data for inflation and GDP growth rate is unavailable, we will use weekly Treasury bill rates and stock market index return as a proxy for inflation and GDP growth respectively. To wrap things up, we will be examining the relationship between stocks and bonds by carrying out an industry-specific regression analysis of the change in stock prices against the change in bond yields and its lags. So what do we hypothesize? We expect that stocks of different industries react differently due to differences in industry-specific characteristics, with most having a negative relationship between stocks and bonds, and others having a positive relationship. In addition, we expect the energy and utilities industry to have a smaller correlation between bonds and stocks since they are government protected. Thank you for watching. We hope you have enjoyed our proposal and see you again next time.
Created using Powtoon.